Okay, so on the third theory of capital structure, we're going to examine the impact of investors' personal taxes on firms' capital structure decision. Why the personal taxes matter? Because the personal taxes of investors will determine whether raising money from issuing stock will be more expensive or less expensive than issuing debt. So, and the third theory is known as Miller, with investors' personal taxes on debt and equity. TS is the personal taxes on stock or equity, and DT is personal taxes of investors in debt or bond investment. So in this third theory, we only have one proposition, which basically say that the value of the levered firm is equal to the value of the unlevered firm plus this term, which basically says the net impact of the benefits of having debt from personal and corporate taxes multiplied by the market value of debt. Okay? So what is TC? TC is corporate tax. TS is personal taxes, investor personal taxes on stock investment or equity investment. And DT is investor personal taxes on bond or debt investment. Okay? So let's give an example. If we invest in stock and we hold the stock for more than 1 year, we're going to get a long-term capital gain. Let's say the stock doesn't pay any dividend. And just a long-term capital gain, we're going to be taxed, let's say it's 15%. Now, if we invest in the bond doesn't really give a lot of long-term gain. The only thing that we receive from the bond most of the time is coming from the coupon payment, and that is the personal taxes of investors investing in the bond of, let's say, 25%, which is greater than the personal taxes on the stock investment. And let's assume that the corporate tax is 35%. And I'm going to use the same example what we used before. The value of the unlevered firm is $13,000 and the market value of debt is $6,046.51, which was derived from the previous theory on the Modigliani and Miller with corporate tax in the previous problem. Okay? Then we apply the formula. The value of the levered firm is equal to the value of the unlevered firm plus 1 minus the corporate tax, 35%, multiplied by 1 minus the personal taxes on stock, divided by 1 minus the personal taxes on debt, multiplied by the market value of debt, which is $6,046.51. So when we calculated that, I usually recommend you to calculate this term first, which is 0.737, and then don't forget 1 minus that term, and then don't forget to multiply with the market value of debt. And what you get here is that the additional benefits of having debt is not as much as under the Modigliani and Miller with the corporate tax. Under the Modigliani and Miller with corporate tax, we have the incentive or the benefit of having debt is $2,116.28. Under the Miller with personal taxes, because personal taxes on stock is less than personal taxes on bond, then the benefits of having debt is not as much as what the Modigliani and Miller says. Basically, the benefits is only $1,592.25 instead of $2,116.28. So that means investors' personal taxes matter in terms of the capital structure decision that the company is going to make. So the higher the taxes on the bond investment, then the personal taxes on the bond investment is higher than personal taxes in the stock investment, then the company will be easier to raise money in the stock. Therefore, their capital structure will be dominated more on equity financing than debt financing. So the benefits of having debt is less. This is an example that we provided here. Now, if the tax on the equity investment is higher than taxes on the bond investment, then the reverse may work also. The reverse may happen, right? what will happen? That means the company will employ more debt financing and less equity financing. So personal taxes of the investors on bond investment and stock investment matters on Miller with personal taxes. So then after this, we're going to continue on the optimal capital structures, which we're going to look at the debt to equity ratio.